Hey, Dan Passarelli here. How are you feeling today? I want to make sure you can hear me. Would you please go to the questions box on the go to the questions box and let me know if you can hear me, please. Just give me a big old yes, big old woohoo. Let me know that you can hear me. All right, Chris can hear me. That's good. Catherine can hear me. And I assume everyone else can hear me. Yeah, there we go. Maria. All right, you guys are awesome. Thank you so much for that. Keith, Merrick, you guys are great. Participating. You're alert, awake, ready to do some good work on yourselves, on your trading. This is awesome. All right, now, before we get started, I need to point out that options are not for everyone, and you should read characteristics and risks of standardized options before trading. Get a copy of that by emailing investorservices@theocc.com. Now, for those of you who are not familiar with me, my name is Dan Passarelli. I've been in the options industry for over 30 years. Oh my goodness. I'm an author of two of the top option trading books. I'm a trader, been doing that for a long, long time, traded as a professional down on the floor of the Chicago Board Options Exchange, Chicago Board of Trade, traded upstairs, as they say, in an office, and now trade personally in my personal account, just like the rest of you. I'm the president and founder of Market Taker Mentoring, the global leader in option trader education. And I'm a trading industry collaborator. I work with a lot of good options-friendly brokerage firms like Firstrade, and I've literally worked with every single options exchange in the world on some basis or another, not just the US, but London Metals Exchange, Hong Kong, China, all over. And I'm a family man. I have my wife, Kathleen, my two adult children, Sam and Isabel. And on a personal level, I try and stay in shape. I run. I'm a foodie. That's why I run. Traveler, been kind of all over the world together with my family and professionally teaching options classes. Been doing that in several different countries besides the US. And also, I'm a music person. I like to listen to it. I like to play it. The rest of my family are also music people. So that's me. Now, let's talk about you. What I want to do is help you as much as possible today in your trading. And one of the best ways that I know to do that is to give you lots and lots of resources. First of all, I'm going to tell you all the secrets to trading time spreads today. Well, most of them that I can think of anyway. But I also am going to give you an invitation to join our community free. And that is the Market Taker community. Let's take a little pic of that. Market Taker community. If you go to markettaker.com and click join free, that will give you some more free classes and free resources. We'll send you our newsletter for free once a week. There are some video courses there. You can also join our MTM community chat room and have more interaction with me, our other coaches, and some of our top traders who post their trade ideas live, real time. Okay, so I want to talk about trading time spreads. And before we even define what a time spread is, I just kind of want to cover some of the major advantages to this thing called time spreads. The major advantage is income. What I mean by that is when it comes to option trading, there are a lot of attributes to the price of options. So a lot of different ways to make money by trading options. And people who are new to options, you think of, well, I could buy calls instead of buying the stock. That way I get more leverage. Stock goes my way, I can make more. Goes against me, I have limited loss. And that's a great motivation for trading options. You can do the same thing with puts to take a bearish position. You heard of covered calls. I did a whole presentation on that for Firstrade about a month or two ago. But there's this other thing. It is income trading. So in addition to direction, when it comes to option trading, stock goes up, stock goes down, I can make or lose money with my calls or puts. Well, there are other things that influence the price, and one is time passing or time decay. All else held constant, like if the stock didn't move at all, calls and puts, they both lose value as time passes. But there are some nuances there. At the money options have the highest rates of time decay. They lose value fastest. In the money or out of the money options, they lose value slower. Okay. But it also has to do with the amount of time until expiration. Options, near the money options with just a little bit of time to expiration, they lose their value very, very fast. But longer term options, they tend to lose their value more slowly. Now, here's where we get into being clever traders. All right. What I just said is the thing you can take advantage of. And that's sort of like the nature of trading. You notice these patterns, these things, and you figure out a way to take advantage of them. Now, short-term options lose value quickly, and long-term options lose value more slowly. What if you sold a short-term option and bought a longer-term option on that same underlying that has the same strike price? Both calls or both puts? Well, if they're both calls, one goes up. If the stock goes up, one makes money, one loses money. Stock goes down, one loses money, one makes money, respectively. Same thing with puts. So the direction is not as big a deal. It is a little bit of a big deal, and we'll go through why that is in a minute. But we get to take advantage of this nuance that, like, we could otherwise just like think of as trivia, but it's not trivia. It's something that we can literally make money from. We can generate an income by making a lot of money on the short ones, losing value, and losing just a little bit of money on the hedge, the long one, losing just a little bit of value. Or at least, keep that hedge and have it not really go against us as much. It turns into potentially a money-making machine, but there are definitely some caveats. There are definitely some things that we need to take into account. So this, what I'm describing here, is just like one type of what I call option-centric trading. Not just this direction trading, but taking advantage of other nuances of options, in this case, making money from time passing by selling options, but at the same time, limiting our loss by buying that long option as a hedge. All right, so what exactly is a time spread? Well, I kind of described it already, but let's narrow in and get really specific. There are two types of time spreads: call time spread and put time spread. A call time spread is when a trader sells a call, which is typically at the money in the nature of trading that I'm describing, income trading, sell an at the money call, and then buys the call with the same strike, but more time until expiration on the same underlying. Now, a put time spread is just basically the same thing. Sell a put, typically at the money, and buy a different put with the same strike price on the same underlying, but has more time until expiration. And now it doesn't matter really if you trade a call time spread or a put time spread. For those of you who are a little more advanced, and I know from past webinars that I've done with Firstrade that some of you are more advanced, you've probably heard of what we call option synthetics, right? Well, synthetics are different relationships between calls and puts in the underlying stock. A call time spread and a put time spread that are on the same underlying, that have the same strike price and the same expirations, but just one is 2 calls and one is 2 puts, they're synthetically equivalent. So it kind of doesn't matter which one you do. Now, time spreads have some synonyms. I must be hungry. Synonyms. They're also called calendar spreads, and some will call them horizontal spreads. Now, Chris is asking question, should a long put be past earnings in a diagonal put spread? Well, Chris, hold on to that question. It is a valid question, and I'm just going to kind of leave it up there to remind myself to answer it. But I want to catch up the newer folks on exactly what time spreads are and get into a pure time spread before getting into diagonals. Okay. Now, a side note here. Call time spreads and put time spreads on the same underlying with the same strike price and the same expiration. Like I said, they're synthetically related, which means they do have nearly identical risk reward to one another. But for now, just know that that's a truth in trading time spreads. And I can explain this a little more further in the Q&A session later today. It's kind of a fun little logic progression. All right, so let's go through an example here. Let's say there's a stock, doesn't matter what stock it is, and it's trading at about $87 a share. And it's one of those stocks where it's in a range or a channel, which means we see support at a price lower than where the stock is. And we also see resistance at a price higher than where the stock is. So when it gets down here, it bounces up. And when it gets up here, it bounces down. It's kind of like when you go to a kid's birthday party at a bowling alley and they put the, what do they call those things they put in the gutters? Bumpers, right? Is that what they call them? Bumpers? So that, you know, this little 7-year-old kid who picks up the 7-pound bowling ball or whatever, because that's the heaviest thing you can pick up, and he just goes, and you know, like it just goes bing, bounces off that one, bing, bounces off that one, back and forth. Like, this is the kind of stock we're talking about. It's got the bumpers up in the bowling lane, right? So difference with stocks and, you know, kids bowling is that there's no guarantee that the bumpers are going to work. In fact, actually with kids bowling, if you've ever been to a kids party at a bowling alley, every now and then one of them throws the ball and it bounces over into the other lane. So, you know, I guess it is kind of the same thing. We don't know if those bumpers or that support and resistance are going to hold, but statistically, usually they do. So what we can do is we can trade a spread that takes advantage of the fact that it's likely the stock will continue in this range. Not guaranteed, and there's plenty of times when it breaks out, but going off past performance is not indicative of future results, but you know, though the past doesn't repeat itself, it does rhyme, as Mark Twain once said. We're going to play by putting on a trade that if the stock stays within a range, we make money. And one of those types of trades is a time spread. So let's do this with calls. Here we're going to sell one September 23rd, 87 call at 78 cents and buy one September 30th. Notice I'm buying one that has 1 week more until expiration than the one I'm selling. 87 call, same strike, both calls at $1.23. So we collect 78 cents when we sell this one. We pay $1.23 when we buy this one. $1.23 minus 78 means we're paying a net debit of 43 cents. Everybody good? Everybody on the same page? Yes, everything's great in your world. It's great in my world. I hope it's great in your world. So there's a couple of pretty simple guides, rules of thumb, when it comes to trading time spreads that you can just memorize. And if you're taking notes, and I always encourage you to take notes, you can do it the old-fashioned way with a pen and paper, or you can do it the newfangled way with like a Google Doc or something or other. However you want to do it. So the most you can, well, let's skip down to the most you can lose first. The most you can lose when it comes to trading time spreads is what you pay for the time spread. In this case, on this one contract spread, we're paying 45 cents for it. So that's 45 cents of option premium. Each option represents the rights on 100 shares. So that's $45 of money on a one lot. If this were like a 10 lot trade, that'd be 450 bucks you trade. So these, these are things that can scale, obviously. So that's the most you can possibly lose on this trade. If you close it at the expiration of the short-term option, I guess I should say. Well, I guess it's still the most you can lose. Okay. The other thing here is how much can I make? Well, when it comes to time spreads, that's a little bit trickier. One thing I can tell you is you can get pretty leveraged profits. It's not an unheard of thing to make 80% in a week on a time spread. Now, that seems like a very impressive number. Like, wow, Passarelli says I can make 80% in a week. This is great. Hold your horses there, partner. Not all your trades are going to work out, and not all of them are going to work out perfectly. And you're not betting your whole account on this. You're allocating a certain portion of your trading to this, and a lot of option traders probably should allocate a certain percentage of their trades to time spreads. So what we do is, we model it out and try and get an idea as to what the most we can make and what our break evens are. Our break evens should ideally coincide with or be beyond support and resistance. So basically what we want to do is we want to draw out a profit and loss diagram that looks like this. Now, again, when it comes to drawing out profit and loss diagrams, I show those in all the webinars that I do here with Firstrade. I show you that with credit spreads, with long calls, with covered calls. But when it comes to time spreads, because the horizontal line is always the stock at the expiration, and there's two expirations, intuitively, we need to do this at the expiration of the short-term option. And when the short-term option expires, it's either worth zero or it becomes the underlying, right? Short, long or short. But we still have the long-term option. And we don't know what the implied volatility is, so we don't know with certainty what that long-term option will be. So we definitely know what the maximum loss is, but we do know that the maximum profit is pretty leveraged. It's kind of up here somewhere. And we also know that the lower break even and the upper break even are like, kind of out here somewhere. There are some online tools where you can model these out that are free to you. If you don't have those online tools to model out spreads like this, please do this. Go to markettaker.com, click join free, join our chat room, and send me a message, and I will get you said tool. All right. Everybody got this so far? Ooh, Catherine's asking a great question. Catherine, do you mind if I just hold off a minute, maybe like 15 minutes before I answer that question? I want to get through a couple more basic items for the newer folks before answering that, but that is a very important question. All right. All right. Thanks, Catherine. That was very sweet of you. She said, of course, exclamations, Wiley Pace. Okay. No questions so far, everyone? Okay, great. Put time spreads. It's just really the same darn thing. Let's say we have a different stock. I could have used the exact same example here, but let's say we have a different stock. Trading at 92 bucks, and we got the bumpers on the bowling alley here. Support at 90, resistance at 95, bing, 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 bing. And half the time the kid still misses all the pins. I don't know how they can miss all the pins when they got the bumpers in the bowling alley. And then every once in a while, the damn ball gets stuck in the middle of the bowling alley, and you got to call somebody, and they got to walk out there, and you know the drill. If you have kids, you know the drill, or if you've been a kid recently, you know the drill. All right. So anyway, here we're going to sell the October 7th, 92 puts at 83 cents. And we're going to buy one of the October 14th, 92 puts at $1.41. Our week apart in this case, same strike, both puts, same, two different expirations. We pay $1.41 for this one, collect 83 cents. We pay a net debit of 58 cents. Now, let me jump ahead here for a second. There's a lot of things that we need to talk about here if you want to be good at this. And give me a big yes if you want to be good at this. Give me a big yes if you're here because you want to be good enough at trading time spreads where you can make money consistently. Chris says, yes, all caps, exclamation. I love it. Nitty, NTI, says yes, which is a good answer. Catherine says yes, exclamation. Maria says yes, all caps, 3 exclamations. Maria's fired up, baby. Maria's ready to go. Thomas says yes. Juan says see. Exclamation, exclamation, exclamation. Wait, don't you have to put like an upside down exclamation in front of it, or is that just with question marks? I don't know. Every once in a while, I get a bee in my bonnet to learn a foreign language. Been working on Italian, but I know with Spanish they do that with the question marks, right? I don't know if it's the same with exclamations, but I'll tell you what, I like your style. In Spanish, you open and close, but that's fine. All right, cool. Excellent. See, we all learned something today, not just for option trading, but a little life thing that helps us get through life, which is like trading, right? Trading helps us get through life. We're not here to because we got nothing else to do. We're here because trading is a vehicle for a better life, is it not? It is. Not only, it can potentially put cash into your pockets, it can potentially lead to a long-term income stream when you learn a strategy like time spreads to grind out profits over time, over and over again, once you get there, which you can get there. But, it's never just about cash, right? What is cash? It's paper, or these days it's electrons. But it's what you can do with that cash. Like, think about that for a minute. Let's talk motivation just for a second. Like, why are you here? Why do you want to get good at trading? Is it to be able to secure your retirement, maybe retire early, go to college, put your kids through college, put your grandkids through college, give to charities, give to your church, right? Like, this is really, really important stuff. All right. So I digressed, but honestly, having that mental reason why you're trading is really more important than the tactics. You need the strategy, you need the tactics, but you also need that mental motivation. You need that mental, deep-seated reason for why you're doing this, right? So always keep that in mind. Okay, so in this example, paying a net debit of 58 cents of option premium, which is $58 of money. We're modeling out a 1 lot here, but if it was a 2 lot, that would be $116. If it was a 10 lot, it'd be $580. 20 lot, well, you know how to multiply. You got a calculator somewhere, right? And it kind of is the same thing here. What's our maximum profit? Well, we don't really know for sure. What are our break evens? Well, we don't really know for sure. We just know our max loss. But who can tell me, how do we get access to a tool to do this modeling? We go to markettaker.com and get in our chat room and send me a DM and I'll help you out. If you don't have access to that already. All right. So there's another thing we can do with time spreads. Oh, no. We still have so much more to talk about here. Wait a minute. Hold on a second. We got to go back here for a minute. This is secrets to the success of being able to do it. I just covered all the basic stuff. There's more to think about here. Now, in the call example, what expirations did I give you? I mean, I kind of just threw out some random expirations here. Oh yeah, good, Juan. Good. These are kind of some random expirations because, there's a group of you who are watching this live, and that's great. They're probably our more motivated folks. Definitely try and attend these live and tell your friends to. But some of you are watching this a month from when we recorded it, 2 months, a year from when we recorded it. So September, October, April, June, doesn't matter what the expirations are. No, these are static examples. Which expirations do we choose? Well, remember I said that shorter term options have higher time decay, which is also called theta, than longer term options. So obviously we're always selling a shorter term option, but specifically, we're almost always selling the shortest term option available. Now, most of the options that you're going to trade have weekly options listed. How do I know that? Because you should be trading liquid options, ones with tight bid-ask spreads. A lot of times when stocks options are listed only monthly, the bid-ask spreads are wider. It's not always the case, but a lot of times. So usually you're selling those options that have a week or less until expiration. Now, sometimes, if it's expiration day and there's 1 day until expiration, or it's 0 DTE, right? Like they expire today, it's Friday, say, that might not be enough time to achieve your objective. If you're thinking, oh, I think we're going to stay within the bowling lane bumpers for a week and the options expire in 6 hours, you probably want to do the following week to give yourself time for the trade to play out and to be able to get enough profit on it. If there's only a couple hours until expiration, the option you're selling, most of the time decay might have happened already. So we're always selling an option that has either the least time until expiration, or worst case scenario, if there's weeklies, the second least time until expiration. Which one do we buy? Now, in this example and in the put example, they're a week apart. Now, truth be told, when I trade time spreads, they're seldom a week apart. Usually I buy more time than just 1 week later. Now, why is that? Well, there's a couple of reasons. One of those reasons is implied volatility. Now, you may or may not have access to the tools where you can look at the implied volatility of a single option. Like what is the implied volatility of the October 14th 92 puts? You know, you don't get that ubiquitously. But, you know, there are sources where you can look that up. And again, go to markettaker.com, join our chat room, DM me, and I can pass along that information just for the people who are interested. I don't want to digress for the people who are not interested. When we're trading options, when we're trading time spreads, we always want to sell options that have a higher implied volatility than the options we're buying. Because from a relative standpoint, they're kind of more expensive. Now, that kind of sounds weird to say, because a 1-week option is always going to have a lower price tag than a 2-week option or a 3-week or a 4-week option. But if the implied volatility of these, which we talked about this in 1 or 2 past Firstrade webinars, if the implied volatility is higher, instead of selling these at 83, we could sell them at 84 or 85 or 86 or 87. The higher a price we sell these, the better. And the lower a price we buy these, the better. And implied volatility is this one nuance. Remember, this kind of, where time spreads, there's a lot of options nuance that we can take advantage of for our own purposes, right? To make money on. When we look at implied volatility, and when these are cheaper than maybe they, or when these are more expensive than maybe they should be, and these are cheaper than maybe they should be, we get some real power. And the way implied volatility changes among the term structure or among the expirations, if implied volatility is higher, it's usually those short-term options that have the highest implied volatility. And then the next expiration has the next highest, next expiration has the next highest, and then it kind of flattens out at some point. So what I like to do is sell that high implied volatility short-term option and buy not, you know, ones that are still high implied volatility, but ones that are lower implied volatility, kind of like where it levels out. We end up getting more of an edge that way. Now, the second reason is if we're looking at a stock that's been in a channel with support and resistance for, you know, not just a week, but a month or 2 months or 3 months, and think it could stay in that channel for not just a week, but 2 weeks, 3 weeks, 4 weeks, then what I can do is I can roll. And we'll talk a little bit more about this in a second, where once we get to the day of October 7th, expiration day, these won't be 83 cents anymore. If all goes well with our trade and we're sitting at the, you know, sitting near the middle here, well, then the reason why that would have happened is because these options we sold at 83 cents lost a fair amount of value. And these that I bought at 180 or 141 lost just a tiny bit of value. So the whole spread gained value, went from 58 cents to 60, 70, 80, 90, or $1 or something. But if we just focus on one option at a time, if this one just lost a tiny bit and all things are still going well, we're still kind of around 92, between 90 and 95. If this one went from 83 to, you know, now it's 15 cents because it's going to expire in a couple hours, what I can do is I can buy it back at 15 cents or a dime, let's just say a dime, leaving a little money on the table, not getting a full 83 cents, but only 73 cents, which is okay because it solves a lot of problems for us. And then, you know, if this wasn't the October 14th, this was more like the October 28th, then what I would do is I'd buy these back, take my 73 cents of profit and sell the October 14th at, you know, whatever. Now they have a week in, well, they'd have 8 days until expiration, right? Because it's expiration Friday. No, they'd have 7 days until expiration. Sorry about that. It's expiration Friday. They're going to expire the next Friday. You know, you could probably sell those at about 83 cents, maybe 80 cents, maybe 85 cents. But I'd collect more and I would just leave these, right? These probably lost a dime. They're probably trading $1.31. Again, we're pretending these are October 28th here instead. So made 70 cents, lost a dime. I'm up 60 cents and I'd take in another 80 cents or whatever. Then I wait until October 14th expiration and do the same thing. If all still going well, we're still around 92, buy them back at a nickel or a dime or 12 cents or whatever, take the lion's share of the profit. These lost just a little bit of money, 12 cents, 15 cents, and do it again. Sell the October 21st 92 puts. And then we've got this system, this machine, where we keep taking in more big decaying asset short options, making bulk on each of those 1 week at a time, and losing just a smidge on these 1 week at a time, on the insurance, on the hedge. The short option is the trade, the long option is the hedge. The goal is to make bulk on those short options, losing value, and let our hedge decay a little bit. That's how it works when it works out perfectly. Now, truth be told, it's not going to work out perfectly every time. All right. You make it through the first week, great. You do that, fine. Now, the next week, it might be trading up at 95. Is it going to go through or not? I don't know. I might still, if I think resistance will still hold, I still might roll it, do the 92, sell the 92 put. But now and then, it's going to jump the lane. It's going to go over the bumper. And it's going to break out over resistance or below support. And that's when we just take the thing off. And, that might be past our break even and we lose a little bit there. And that's okay. Trading is not about knowing that the stock is going to do a certain thing. Trading is about having a system, understanding the nuances, having either more winning trades than losing trades, or taking bigger profits than your losses. In a perfect world, when it comes to time spreads, we actually want to do both. We want to have more winning trades than losing trades, and we want to have our profits bigger than our losses. So, once we get through a break even, or we get to, a point where we lost a certain amount where we're going to mentally stop ourselves out, we're not going to use a real stop order. We never do that on spreads because there's two bid-ask spreads. That's dangerous. But, we look and we say, hey, if I lose 20% on this time spread, I'm going to close it and take a loss. If I make a certain amount, then I'm going to take a profit. I'm going to talk more about that in a second, but I just wanted to kind of give you an idea. Okay, so managing. How do we manage these? Let's start out with this one, actually. There are two things that can happen on this trade from a broad category standpoint. We can make money or we can lose money. And if you trade 100 time spreads, you're going to have plenty of both of those. So we have to have a plan to manage these trades. And we have to have a plan for both eventualities. First, a profit-taking plan. If I make a certain percentage profit on the time spread, I'm going to take my profit and close the whole trade. Or if I sold a 1 week one and bought a 4 week one and it's going perfectly, my plan might be to roll and do it again, like I'd already described. Now, if I'm closing the trade and not rolling, I might choose to scale out. I might say, hey, if I make a 40% profit on this 10 lot, I'm going to take a profit on 5 of them at 40%, and I'll hold off for 60% on the rest. And these are reasonable profit target goals, by the way. 40%, 60%. You'll see that with time spreads. So I might do that. That's called scaling out, where I close some at this level, some at this level. Now, what if it goes against me? Well, you're going to see some of those too. You make 100 of these trades, you're going to have some losing trades. So what do? Well, I want to monitor each of my time spread trades. And if I lose a certain amount, I'm going to close the trade. And that amount is more like 20% or 25%. Or I could set it where if I do have a tool to calculate my break evens, if it goes through my at expiration break even, I'll close it there too. But, you know, let's keep it simple and just think of it as a percentage. If I lose 20 or 25%, I'll close it. And, you know, that is often thought of as a stop loss, right? If I lose this much, I close the trade. I'm going to set a stop loss order. No. With spreads, because we have a bid and an ask on two different options, if I set an actual stop loss order, what happens is when it triggers, I sell the bid on this one and I buy the offer on this one. I trade at the worst possible price. What I always want to do with any spread, whether I'm getting into it or out of it, is I always want to middle the market a little bit. Like these are time spreads, so I'm buying them, right? When I'm opening the position, I'm buying them. So if the offer is 95 cents and the bid is 85 cents, the middle is 90 cents. Now, you seldom are able to trade right in the middle, so I might put in a bid. You know, remember, 85 cents is the bid, 95 cents is the offer, 90 cents is the middle. I might put in a bid of like 92 cents, a little bit above the middle, but still below the offer, so I can buy it a couple cents cheaper. You know, you buy it 1 cent, 2 cents cheaper of option premium, that can cover your commissions. You know, maybe 2 or 3 cents, but still, I mean, great, right? So if I were to set a stop loss, an actual stop loss order, then guess what? I'm not trading in the middle. I'm selling the bid on one, buying the offer on another. I'm selling at the spread's bid, the worst possible price. So what I do is I just monitor the trades every day, look at them, and say, hey, if, you know, well, I actually, you know, I encourage all of our students to keep a spreadsheet. I actually have a spreadsheet that I share with some students on occasions. Again, go to markettaker.com, join our chat room, ask me about it. You keep a spreadsheet so that you always know what price you got into the trade. And if it's worth 20% less, or, you know, $1 less or 50 cents less or whatever, then you say, I've hit my mental stop. I'm going to put it in order to sell this below the mid price, but above the bid. I'm going to middle the market. So as far as the profit taking plan, I don't care if I trade on the worst price. If I get my 60% or 80% or whatever it is, I'm good with that. So for the profit taking plan, I'm going to enter my closing order immediately following getting into the trade. And I'm going to set it good till cancel, or good till 90 on the Firstrade platform, good till 90 days from now, or expiration, whichever comes first. So as far as managing time spreads for, let's start with profit taking orders. As far as managing the profit taking orders, we're going to set a profit target between 20% and realistically 65%. I mean, there are absolutely times when I've made 100% on a time spread, 120% on a time spread. That's pretty greedy, though. You run the risk of, oh, hey, I'm up 95% on these. I'm going to hold out for another 5%, and then the market moves and now you're making 10% or losing. So we don't want to be too greedy. I like to set my profit target between 20% and probably 65%. If it's really working out just perfectly and I'm scaling out, which we'll talk about again more in a second, you know, the second scale out might be higher than this. So what does that mean between 20% and 65%? Let's say I bought the time spread at 88 cents and I set my profit target at 50%. So 50% of 88 is 44. So if my 88 cents trade is worth 44 cents more, that's 44 plus 88 is $1.32. So I would literally set a good GT90 order to sell this for a profit at $1.32. Now, if I want to scale out, I can set 2 to 3 profit-taking exits. So on that same 10 lot, I bought 10 at 88 cents. I'll set one limit to sell at 50 cents or 50%. So that's $1.32. And another to sell the other 5 at 65%, which is $1.45. 65, basically you take 1.65 times 0.88. Now, let's go back for a second. Dan, this is a big range. 20%, 65%. You say on the second one, it could be 80%. How do I know which one? Can't you just tell me one? You can just pick one and stick with it. Like 40% would probably be a good number to stick with. But as you get better with these, you're going to say, man, this one has been in a channel for 3 months and it's just really solid and it's got a volatility skew and everything is perfect with this. This is the best time spread I remember seeing in 6 months. You know, that one you're probably going to be a little greedier on. You're probably going to try and take 65% or something. Oops. But if you look at one, you're like, man, this does meet my criteria. It is a good time spread. I kind of have seen better. I am worried about this one thing. It doesn't nullify the trade in this case, and sometimes it will. It doesn't nullify the trade in this case. I still like it, but I feel like I want to be a little bit more conservative. I might set that for a 20% profit or 25% profit. Okay, now what about the other thing? How do I know when to close a trade? Well, or for a loss, if that happens. Well, a very simple, straightforward way is to say, hey, I lost 20%, I lost 25%, close the trade. Another thing is think about, why did I make the trade? Well, I made the trade because there's the bumpers on the bowling lane. There's the support and there's the resistance. I think it's going to stay between support and resistance. Guess what? If it goes below support or goes above resistance, the whole thesis of my trade was wrong. I shouldn't be in the trade then. So I close it. And hey, you know, if enough time passes, you might be able to scratch it and not lose money, or at least not lose much money. Or if a new volatility event is announced, consider closing the trade. There's another pro tip I can bring up. When you're first analyzing the trade and looking at it. Oh, and Catherine actually asked this. No, she asked something she asked something different. I'm sorry. I'm going to answer Chris's and Catherine's questions in just a second, and any other questions you might have. Before I put on a time spread, I want to make sure that there is not a volatility event scheduled to be announced, like earnings, or like the next Fed announcement, or you know, PCE inflation gauge, or the monthly non-farm payrolls unemployment report. I typically want to avoid those events. Now, I will say that there are other uses of time spreads than we talked about here today. And one of them actually is to trade earnings, but that is a very, very different way of looking at time spreads. In about a month, I'm going to do, in about 3 weeks, earnings season's about to kick off, and I'm actually going to do a presentation on that for people who are on my email list. But all that said, generally speaking, if we're just doing this for income, we want to avoid earnings. We want to avoid Fed announcements. We want to avoid the PC inflation number and the monthly non-farm payrolls. If we have the trade on and a new volatility event gets scheduled during the life of our trade before expiration of the short-term option, we're going to want to trade out of that too to avoid that risk. Now, why do we want to avoid these scheduled volatility events where news is scheduled to come out? Well, because remember, the only way we can lose money on a time spread is if it goes down or up too much. So we want to avoid situations where there's the potential for it going down or up too much. And when news is scheduled to be announced, big news, that's when that's more likely to happen. Thing is, with stocks, they say stocks go up 8 or 10% a year. Well, that's not just a straight line. Every day it goes up a smidge. There's volatility. And some of that, 8 or 10% is when earnings comes out and it goes up 12% on this stock or down 15% on that stock. So we want to avoid that. Okay. I am going to take some questions now. Chris asked earlier, Aslam, is there a way for you to summarize that? When people ask really long questions, it doesn't make for good for this forum because I have to read a paragraph and I get lost and other people get lost. Is there a way to ask that in a shorter way? In the meantime, Chris says, should the long put be past earnings in a diagonal put spread? So a diagonal put spread is a time spread just like we're talking about, except it's two different strike prices. And it could be higher or lower. I mean, the most common diagonals is with calls, where I buy a long-term low strike call and sell a short-term high strike call. They call that the poor man's covered call. But they can be constructed with puts or with calls. The short-term option could be a higher or lower strike than the long-term. It doesn't really matter. So that's what a diagonal is. Should the long put be past earnings in a diagonal put spread? Put credit spread. So the short option always needs to be before earnings. The long-term option, I'm okay with it being after earnings, but the short-term always has to be before. And you should probably close both trades before earnings because it's really difficult to pick direction on earnings. Okay. Does that make sense? Catherine also asked a great question. She said, with call time spreads, there's a risk of early assignment if there's an ex-dividend date coming. Can we construct put time spreads for the same direction with the same risk reward? So yes, great question. Something that I love to talk about. So if I'm looking at this, well, let's do the call time spread. If I'm looking at this call time spread, and, I think, the stock's bouncing around between 85 and 90, I think it'll stay there. I could buy this call time spread. I could pay 45 and, my max profit might model out to be like, 50 cents or something. If I instead did the put time spread, I'd pay a similar amount and my max profit would be a similar amount. Now, it's not going to be identical, because interest affects calls and puts differently, and early exercise affects calls and puts differently. But the simple answer to the question is yes, it's going to work out basically just about the same. The reason why you would get assigned early on a call is, just as you astutely pointed out, Catherine, there's an ex-dividend date coming. But here's something to add to that and to think about. You're only going to get assigned on that short call if it's in the money by enough where the time premium left, like if it's in the money, there's going to be intrinsic value and time premium. If the time premium is so small that it's smaller than the dividend once you factor interest into the equation. So if it's that much in the money, it may already have gone against you so much that you might be thinking about taking it off to begin with. That may or may not be the case. If it's a really tiny little dividend, it might not be the case. But yes, you do run the risk of early assignment if the short call is in the money enough. If you do the put version, you're not going to get assigned going into the ex-dividend date. But you can get assigned early on puts if the short put is in the money so much that there's barely any time premium, and the interest on the market maker who's long that put and is long stock against it, and therefore has to, market makers do things on a more leveraged basis. They're borrowing money to buy that stock a lot of the time. If the interest they have to pay to borrow that money is more than the time premium it costs them to carry that put, they'll just exercise that put, so they don't have to pay the interest on it. But, with puts like that, if we're trading 5-day options, you're unlikely, if you run into that problem, that put is so deeply in the money that the spread's probably really far against you. Now, if you're doing monthly options and they're liquid enough to trade, bid-ask spreads are tight enough, you could run into that without the stock having moved through your break even, where you're losing too much. So just know that you can get assigned on puts as well if the short put is in the money enough. Very good questions so far. Azam says, where can I back test a calendar spread? There are places to back test them. I've got a couple of friends that I can hook you up with. I think it would be inappropriate to say this in public, but like I said, go to markettaker.com, join our chat room, DM me. I can answer any questions that are really specific to you, or, ones that aren't appropriate for this forum. And I'm happy to do that. Very happy to do that, as a matter of fact. All right. That being said, I hope that this was very helpful to you. And I hope that you'll join us again next time. Once again, I'm Dan Passarelli. Have a great rest of your day and trade smart.